My name is Bryan Walker. I'm a managing director with Grant Thornton, based in the Bay Area. I work on financial diligence for M&A transactions. So a lot of my clients are private equity investors. We also work with companies. We do nowadays we do diligence both on the buy side and the sell side, which we can get into later. But as part of Grant Thornton, which if you're not familiar with the firm, we've got 7,000 professionals across the United States, about 100 people in the Phoenix office here, providing accounting, audit, tax, and assurance, and services all around the M&A life cycle.
Thank you. Jerry?
Hey, Jerry Bostelman. My company's VACO. We help companies primarily through slayers like Valdo, Mike Green, and Jarrett over there with our Phoenix team, with CEO to customer service rep on a project and permanent basis. We've got about 40 offices across the country, and we've been sugar daddy, private equity backed from the very beginning. We had some angel investors originally. Then we went to Quad C, which was a really good regional firm. And then we went to their city cousins in Olympus, which is a little bigger, a little richer, out of Connecticut. And we served every imaginable type of private equity firm through the services we provide.
Thank you.
Ryan SMEETS, Big Yam, the Parsons Agency. We have a very interesting structure in that we're backed by Mr. Parsons, and we have over 15 companies in our portfolio across real estate, motorsports, marketing and advertising, as well as golf equipment, and golf course. My general rant as the marketing communication professional is that I feel like these folks up here, the team that we've assembled, they get an early seat at the table for the messiest situations in business, and I'm here to elbow my way into that conversation as much as possible. And with the PE firms, we're doing a lot more work where we're talking to them in the due diligence process about the companies that they're adding into platforms within their portfolio in terms of the brand reputational value of those companies and the assets and the culture internally that they have. Thank you.
Thank you. TRINDL?
Hi, good afternoon. Oh, test. Hello. Can you hear me now?
We got you.
I'm TRINDL REEVES. I work for MARSH McLennan Agency. So we're a large commercial insurance brokerage firm, and we kind of work on two sides of the house, everything related to the business insurance, property and casualty, and then the healthcare plans. So our clients are the private equity firms that are going in and buying a portfolio company, and they're going to either make an acquisition or maybe merge it with something else, another asset that they have, and we will go in and do due diligence. So I'm going to talk to you a little bit about how we do that process and how we play in the private equity space.
TRINDL, can you just orientate the folks here for, there's a local firm that you're now
Yes.
part of. Can you
Yes,
speak
so
up?
we recently partnered with LOVITT and Touche. I think some folks are here in the audience. So we're all one now, and we're going to help LOVITT and Touche grow a little bit more here in the Phoenix, Tempe, Tucson area where they have offices, and I'm really excited about the partnership and been over here a few times in the last month already. So that's our big news here.
Thank you.
Steve BOATWRIGHT with the law firm of Gallagher and Kennedy, and I kind of am involved mainly in protecting my clients from money. And I'm sorry Craig Weiss still isn't here because he cold called me to represent him in the Enjoy transaction. So I wish you were here so he could respond to that.
We have that on tape, by the way.
Yeah. That's funny. Good afternoon, everybody. My name is Don ALIX. I'm here with INSPERITY, and our mission is to help businesses succeed so the communities prosper. We heard a lot about mission statements and mission-driven purpose in businesses this morning, so that really resonated with us. Our exposure to private equity and through companies like ACG is really working with them. You know, anytime there's a change, and there was a little bit of talk about that this morning as well, in the troops and with people, usually we're resistant to change. And our specialty is in human capital management and kind of motivating people and making sure we get the most discretionary effort out of people. So that's kind of how we coordinate when we work with private equity.
So Don is with INSPERITY. You'll see in your program that we have Donna. We just replaced Don with Donna today, so Don's with INSPERITY in the program. So I'm going to ask a series of questions for all of you to answer, and then we'll have some individual questions for each of you. So for the panel, you can each answer this one at a time. What do you think are the biggest challenges of attracting private equity here to the state of Arizona. Ryan, could you take that on first?
Sure. We've seen it. Well, number one, I'm not from here, so I've been in the Valley for about 12 years, and this latest stint has been about 8 years. I grew up in Southern California with the short stint in Washington, D.C. The last 2 years, I've seen a lot more interest in private equity coming out to Arizona through different networking professional events here within the state, FEI, ACG, and the like. I think the challenge has been for many of the middle market companies that I talk to and that I know within my network is that, and I'm gonna speak to both the B2B side and the B2C side. I think this is a tremendous business climate to start a business in. I don't know what Mr. Parsons is going to do next, but I do know it's going to be here in the city of Scottsdale in the state of Arizona. And this is one of the last great states where you can come, you can reinvent yourself, and there's a ton of goodwill. I said I'm not from here. The business community has really validated that. I don't think you have to look very far to prove that. Let's look at our governor, right? Let's look at how many governors back do you have to go to actually find a native governor in the state of Arizona. Okay, so we have a lot of that goodwill in our community. I think the challenge has been that we have that pioneer mentality, and there's been maybe an unhealthy distrust of the coast, and an unhealthy misperception of private equity. And so that's what we're trying to do through this ecosystem of excellence, is be able to have that conversation and educate more folks so they can build that company, they can grow that company, they can have a succession plan that works for them, and it's not just this lifestyle business of companies here, or it's not just a place where we can attract companies so that they can have their data centers and their call centers. We can have a rich environment of respected and executive talent here in Arizona.
Yeah, so if you didn't get from the introductions, everybody here in the panel has significant private equity experience, probably as much as or if not more, than the panel we had up before. So they're steeped in private equity, gone through, or either private equity backed at this point. So, thank you.
I travel a lot from a private equity perspective, and our support center is out of Nashville, Tennessee. So you guys win in terms of the number of private equity sponsors in a single city. I'm very impressed with the family offices, with the number of PE firms that you have here locally. Also, if you think about what a private equity sponsor might want to invest in, a diversification of geographies is not a terrible thing. I know that most of the firms that we talk to loved having somebody in Nashville, and they would love to have somebody in other areas so they could diversify the risk. Also, our guys are out of Connecticut. Your January is a hell of a lot better than Connecticut's January. And finally, there are worse things than having your private equity sponsor a plane ride away. It's a comfortable distance.
Yeah, agreed. Steve, can you take that on?
Accountability. That's the hardest thing that the people have to overcome in getting private equity money, because it's easy in this state to get unsophisticated angel investors to back your venture. And I have the conversation all the time. Had it with a client today who has a guy that's on the board of Tesla on her board and a fabulous advisor for her company. And she has some passive investors that she's happy are passive and have no idea what's going on. And she has an opportunity to get a pretty active private equity investor, and she's saying to herself, why would I do that? Because I don't have accountability and I'm doing just fine right now, and I don't want any more accountability. I want the freedom to do what I want to do, and I have capital coming in other places.
Don, take that on.
We don't get directly involved with the private equity except through the clients that we work with, but I would say, you know, we are the 5th or 6th largest city. I think it's a limiting belief to say, hey, you know, Arizona is not a hotbed for that. And I just need, you know, there's so many examples, you know, in this room and around the state that we've worked with that it is happening here. So I just think that's a limiting factor in people saying that the world's getting so much smaller. It's so much easier to get, you know, wherever we need to get on a plane or what have you. So, I mean, I don't know if that's a reality or if that's just how people have perceived things in the past.
Yeah, thank you. I think it's a testament to I think we have about 10 private equity firms here today, which is a testament. I've done a lot of these. I don't think I've seen 10 private equity firms come to one of these events. So it's a testament to what's available here in Arizona. So let's talk about, this is for the panel, let's talk about where do you see the most activity B2C or B2B and acquisitions? TRINDL, you want to take that on?
The transactions, in the first quarter, we had kind of 18 deals closed, I think, and we have 61 in the pipeline. And most of them are kind of B2C. Not sure why that is, but just the things that we saw that were being funded were of that ilk. A lot of healthcare, and again, I don't know why that is. It seems like they're doctor groups, dentist groups, eye care companies, kind of rolling together, smaller companies they're trying to aggregate. And then technology, I would say, would be the kind of the core industries of those. So that's what we're seeing.
Jerry, any input?
Well, we're in the business-to-business space, and it's really frothy. We're looking at a deal now. I've got a team that's in D.C. looking at a group, and for us, there's no shortage of deal flow. Its culture is so important that we probably pass on 95% of the deals we look at. Organically, we can instill the core tenets of VACO. It's got to be a lot of due diligence in terms of the teams to see what's going to be a great fit. But we see a tremendous amount in the business-to-business space also.
Brian?
Yeah, most of my clients are also investing in B2B. I think with the underlying demographics of a large addressable consumer audience, though, and so things like HRIS in the tech space, payroll processing. We got multiple private equity clients investing in trying to do roll-ups in spaces like that.
Steve?
I think here I see both, and just depends on the quarter and what's going on.
Don?
Our business is all B2B. I would echo what you said as far as healthcare. I think we're seeing a lot of consolidation in that, and the way we get involved is trying to blend cultures and make sure that, again, they don't lose any steam or any revenue as they're going through that. As people, there's rumors going on or people worry about their culture, some of those things, but ours is all B2B.
Okay. Can you each individually speak to sort of your rates and value that you offer into either the company market or the private equity? So a private equity firm has a portfolio of clients. What do you offer, and what are the, if you are willing to give, what are the rates that you give for that services? Start with Brian on the M&A side.
So we're going to see who's going to give up their rates first.
Yeah.
So around M&A, Grant Thornton obviously provides audit and tax services. And then when it comes to M&A, I spend 100% of my time doing financial diligence. So heard some comments about that from the earlier speakers, and I don't know if I'm flattered or offended by some of the ways they refer to people like me. But then so we'll help companies prepare for that diligence process. We will come in on behalf of private equity sponsors and perform the diligence ourselves. We also help with post-deal integration. We have professionals in our group that specifically look at that sale and purchase agreement and advise and work with the attorneys on making sure that the accounting language in there, whether it's a working capital adjustment, whether it's an earn-out, that there's a basis to calculate that and hopefully avoid disputes later on. But if there are disputes later on, we have professionals that help work through those as well, and including some of my colleagues that are based here in Phoenix that I work with quite a bit on M&A transactions. In terms of rates, Grant Thornton, we are the 5th largest accounting firm, and so we're not the Big Four, and I think the expectation from our clients is that there's going to be a discount to the Big Four when you come to Grant Thornton, and we can usually accommodate that expectation. M&A is an area that does usually command higher rates, than a year-end audit. But as a firm, we are really focused on the middle market, private companies especially, and so it's a very good, I think, intersection with the private equity clients that we're serving, who are focused on the middle market. So if you're looking for a dollar amount on the rates, give me your card.
Thank you. Jerry?
Thanks. Well, we're in it for the long haul. I've been supporting VACO for almost 17 years, so at this point I'm not qualified to do anything else. We're really looking for a long-term relationship with clients. We've served over 14,000 since inception. And then if you extrapolate my experience to the rest of VACO, because we're an LLC model, each city, the largest shareholders are those individuals that are running it. Like Valdo's been with us 13 years. Mike's been with us 12, and I know Jared's been with us 7 years. So since we are in it for the long haul, we're trying to find ways that we can service our clients at a deeper level. For example, we have a retained search division that we've invested in heavily so that we can help a private equity team upgrade their executive talent. From there, we can come in and help with their systems implementation through our technology group, or through our healthcare consulting group implementation of EMR. But then again, we're not done. We're just getting started in that if you want to relocate an entire shared services center, like we're doing for a client that I bet everybody knows, Icy, the drink, from California to a southern state, we're able to relocate hundreds of positions with those players. So as far as what we try to do is understand what a private equity firm would want and be a complete, holistic solution, a comprehensive service for them so that they can have one call. We can be successful on that individual project, but by the time we get that 10th, 12th, 13th, 78th project, we're even more effective. And from a rate perspective, more is more, or more is less. So let's do lots of work together and we'll price it right.
Great. Thank you. Brian?
Great answer. So I would start by answering that question by saying, the other service providers up here in the panel, Stephen has to keep his bars current. There's different certifications that you have to stay current on. Marketing and advertising, right? I think that's probably the most skeptical profession out there after a personal injury attorney. So if anybody else can think of something that I think most people are more skeptical of or want to go cheap on, it's going to be marketing. But as we heard from the last panel, when it comes to going out and raising money, finding better partners, getting to hire multiple, storytelling is everything. And so for us, we're doing a lot more work on brand storytelling, brand strategy. And I think we're unique because of our backing by Mr. Parsons and the companies that we've worked with. I always like to explain Big Yam as on your right hand, you might have traditional marketing advertising agencies that they get really frothy at the mouth when they hear about the millions you're spending on media, and they want to take a commission on that. That's not us. On your left hand, you have management consultants who are encroaching on us in our territory in the sense of they've been doing strategy to their methodology, and they've been seeing what the media is like, and they've been seeing what the marketing is, and they've got on all their own buzzwords, right, like customer experience and organizational change management or whatever it is, right? And they're really good about helping you keep those clients and cross-sell and upsell, but they don't have a creative bone in their body. So we're down the middle. We're right down the middle in the sweet spot there. In terms of our rates, we're very competitive, and we'll take on projects. So we don't have to overreach for a 1 year, 2 year, 3 year commitment. Let us prove ourselves. Let us work ourselves out of one mess and into the next. And so where our capabilities are, brand, public relations, software development, there's a lot of things that we can do if it's right to fill in that gap for the client. And we're finding ourselves working ourselves out of jobs in the middle market where we come in, we do a strategy, we go out, we help them hire the team, we work around that team, and we work into another project. In terms of specific rates, yeah, I'll say it. We're less than $200 an hour when you look at a lot of the projects that we do, which if you're going to compare to other markets, LA, we're probably 30 to 50% cheaper. Austin, Dallas, probably the same, and a lot more if you consider Chicago and New York. Now, that being said, there are companies that like to go and do business and have their creative people in Southern California or Chicago or New York. And to them I say, stop wasting your money. Come here. We don't have any debt, and we don't have to pass that off to you. We can find a mess and work it out together.
Thank you. Tina?
So we engage private equity really in two ways. One, we can go into an existing portfolio program that you have a PE firm sponsor, and they say, hey, we want to aggregate our buying of insurance. So we'll go in and, for instance, negotiate D&O insurance with one carrier for all of the portfolio.
What's
And
D&O insurance?
It's insurance for the personal assets of the board, which is kind of important, right? So that insurance, you would negotiate it as one one program, and you'd allocate the cost over the portfolio on a percentage basis. And so that's going to save every company a little bit of money, but more importantly, you've got quality coverage for each of those companies, and the private equity firm is now better protected at the first layer of defense at the portfolio level. And then they also carry their own insurance at their level. So we'll go in and do that. That's a cost reduction and quality play, looking at a portfolio program for the PE firm. But probably more frequently, we do due diligence on transactions where a PE firm might be going in and buying a company. They don't know really if it's a good risk or not, and they don't know what it looks like going forward. If they're self-funded on their medical plans, what kind of unfunded liabilities are out there? What kind of products do they have? Do they have any product quality issues? There's a lot you can tell from the insurance program about the quality of the company and how well it's run, and how much those products and services that they're selling are being received in the market. So we'll go in and go into the data room and do due diligence project where we'll actually kind of red, yellow, green what the issues are for that transaction, and then the PE firm sponsor can look at that and go, yeah, this is a deal breaker or not, or is it going to be accretive to earnings when we buy this company, and what do we need to do to fix it? A lot of brokers will go in and charge for that process, and we don't. We will actually go in for free and do that due diligence process, the deliverable, the communication, the readout report, and the whole bit for no charge, assuming we're going to get the work going forward. And most brokers charge regardless for that particular process. There's also what's called reps and warranties coverage. We call it transactional risk because there's different parts, but mostly it's reps and warranties coverage that actually insures any unknown liabilities that might come forward later on in the transaction, or maybe 2 or 3 years later. You can actually buy a policy that will replace the holdback that might be on the deal, and that's a very popular coverage now. About 50% of the deals are having that kind of coverage involved. So that's usually how we engage, but I would say the big differentiator is not charging for due diligence services.
Yeah, we're going to examine the records in a few of those too. So
Okay.
Thank you. Steve?
Yeah, our firm does the legal due diligence and, of course, the documentation of the transactions that are involved. And the difference of Gallagher and Kennedy is we're not a national, international firm. We have an office here in Phoenix, an office in Santa Fe, so we don't have the issues that in my past life at a large law firm in Chicago that had an office here, where we have to figure out some of these firms, you have an office that's not doing as well, then you outsource to that different location, even though they may not have the expertise and the relationships in the local vicinity. So that's the advantage of a firm that knows this region space really well and has relationships that are pretty broad. In terms of hourly rates, we're much more competitive, I think, than many of the international, national firms. And again, because we have a whole team that from paralegals to associates to senior partners, it's kind of whatever at the time the client needs that bears the burden of the expense. But generally in an M&A transaction, you have heavy associate involvement by definition, because you have a lot of preparation of schedules that need that heavy lifting by the associates.
Don?
I'll start with the rates. So our firm is definitely a premium provider in our space. And for that, we obviously have to show what that value proposition is, right? So companies like HelloFresh, BuzzFeed, Netflix started with us with a handful of employees. And kind of like what Ryan was saying, if we're successful, we get them to the point where they're up and out, and that could be through merger and acquisition or through private equity and doing something else. But for those of you in the room that have written your name on the front of the check and not only the back, we take a look at your payroll fringe or your burden, and we challenge to get some type of return out of all of that, which, as a business owner, I got to a point, I had a business for 11 years, and I knew based on my gross payroll pretty much how much I had to have in my bank account, right? And as you're growing your business, you either have some type of line you're drawing on, or hopefully you have enough money in that account to make that happen. But what we do is we try to, we put together a runway for small businesses to where instead of them having to do all of those things, acquiring insurance, inquiring benefits, inquiring a 401k, payroll, all those type of things. We have that runway built, and they can jump on that and build their company to whatever they want to be. As far as private equity goes, private equity, if they get involved, they're looking at not just how much money the business is making, but what are the risks, right?
Yep.
So a lot of times, we will show in our value proposition how we'll take a lot of the risks of being a business owner, whether it is volatility related to expenses you have, or if it is the risk of being an employer, which there's all sorts of them. As many of those as we can offload and co-share in some of that risk. I know private equity likes that. So when they partner with firms that maybe we have brought up to a point to where it gets to them, they know that valuation is less risky than maybe other options that they have.
Yeah, so it's drive revenue and reduce risk simultaneously.
Yes, people that get up in the morning and think more about making money than how do I save money is a better fit for us.
You should figure out how not to lose money first.
Yes.
Yeah. Okay, we're going to get some individual questions. I want to start with TRINDL. Can you, I want to talk about the due diligence process. Before a private equity firm goes in to buy, I want you to examine the wreckage for us. Tell us a story about what happened to a company that you went in who you didn't do due diligence on, and what was the results?
Well, yeah, I mean, I've got lots of good stories. But, the private equity firms, their number one objective is to make sure when you're merging a program, 1 + 1 equals something less than 2, right? And they want quality coverage. The situation I was working with, it was a private equity firm that did not regularly engage us to do due diligence. And I kept saying to them, give us a shot before your next deal. I looked online and saw that one of their portfolio companies that they had already invested in had a claim problem on workers' comp. And I brought it to their attention, and they said, yeah, we'll talk about it. 6 months later, it's getting worse. And I'm seeing this, in databases that I can get to online. And saying it's getting worse, you really just need to let us go in and do a post-close acquisition project, just due diligence, let us go take a look. So finally, they agreed to do that. It's a family-run business, large bakery. And, they have a fleet of cars, lots of employees. They make the stuff there on premise. We do a whole due diligence project and find that they have just massive problems all through the organization. They have workers' comp claims that are probably 3 times their peers. A matter of fact, the day we were signed on, a woman cut her finger off because they had the wrong procedures as far as how they lock out, tag out with the machinery. The fleet was decrepit. Some guy broke down in the middle of an intersection, caused a $6 million accident. So this was all within days. We haven't even finished the report. And so long story short, we go in and we end up getting that client. We do a renewal, kind of straighten things out, get it a little bit under control, start doing some loss prevention work, start helping with some claim situations to try to stop the bleeding. And I went into the partner and I said, here's where we've been, here's what we've done, and here's what you've got. And he looked at me and said, had I known what I know now, I would have never invested in this company. And fast forward, that was October, fast forward by Christmas, they were out of business. And they lost everything they had on it. So, needless to say, we're doing due diligence on every deal they do now. But that's a perfect case study on why we can see a lot through just what the behaviors are in the company just by looking at their prior claims, just going in and talking to them, looking at what the program's set up like. I'll share one other quick story. We had a merger transaction going on of 2 hospitality groups. Large private equity was funding the merger. And we went in the data room and said, all together, combine the premiums, it's going to equal $3 million. But when we're done with it, it's going to equal 2.7. Sounds like a good thing, right? So we get into it. We're talking to the insurers, and we find that the reserves on the workers' comp claims for one of the carriers, it was a very small insurer that didn't have proper reserving practices. It was all underfunded to the tune of about $500,000. So the projections that were made were on false data. So we had to go back to the private equity and say, remember that 2.7? We've got a $500,000 problem. We're underfunded. We think that equates to about $400,000 in additional premium. That doesn't equal that doesn't get to, 2.7. Now we're over 3. So now immediately the deal is not accretive as what they had in their models for when they purchased the companies and they put them together. So we got busy and started working to reduce cost in other areas of the program to hit that 2.7 target. We ultimately did, but it was a scramble. So that's just a little look into kind of some of the things that we do.
Thank you. Don, I want to speak to PEO firms. Can a PEO firm help to solve some of those problems post-transaction or pre-transaction?
You should be able to. I mean, we had a firm here.
First of all, can you describe what PEO is?
Professional employer organization. So our company founded about 33 years ago, founded as a company called the Ministaff. Founder still working and running the company today. Rebranded about 10 years ago. But yeah, in some cases, you can. We had a firm maybe 6 months ago that 60 people, been around for 15 years, making a lot of money, had employees in multiple states, and some of the due diligence that you're talking about when we got in there, we advise and guide and encourage business owners, and we only tell them what to do if it's a illegal thing, right? We suggest, but we partner with them, and if they decide, hey, I'm
They
going
can call
to...
Steve afterwards.
Yeah, exactly, and we have them on speed dial, but if they want to do something, we allow them to go do that, unless it's an illegal thing. So this firm had a long track record of being very successful, and one of the things they were doing is they were paying their employees in different states in arrears longer than was allowed. Right, and they've been doing this for years and years and years. So part of that due diligence was to say, in these 3 states are okay, but you have huge liability here, and their excuse was just that we didn't know, right? So little things like that can make a big difference. Having owners on a healthcare plan and they're contributing to an FSA because the company that they're partnering with says we could do it. Well, I would think that your partners would say, you're doing this, but here's the ramifications of that. Those type of things I think we need to get into, and it's, if you can develop a rapport with the business owner and the trusted advisors and leadership there, say, hey, I'm going to ask for permission to challenge you a little bit in some of these areas because this is, our area of expertise, and they're open to that, then that fosters a really good relationship. And again, what I heard this morning with some of the business leaders was it wasn't so much what I need to do in business, but what I need to avoid. And sometimes a lot of, what wipes out a lot of attaboys. So when we're doing that due diligence, that's where we really focus our time. I know how to do the basic things in the business and provide insurance and do workers' comp and do payroll, but I'm really looking for areas where they're making large mistakes, and if I'm suggesting a solution that it's not preventing another unintended consequence, in their business. So yes, it should come up if you're doing it the right way, and it's done the right way when your mission, vision, and values are aligned with the business owners. In other words, I'm giving advice as if it's going to affect me because in our business model it does, joint and severally with them.
Right, in the PEO model. Steve, you want to take a crack at that? Do you do due diligence along with an insurance company? Would you do that as an attorney?
I don't think that we ever have. I mean, I think our due diligence is of a legal nature, and unless you have an insurance of your reps and warranties, which in that context that certainly would come into play. But they're doing their separate, due diligence with their own counsel, and that's separate and apart from us. So they're 2 different kind of paths that are being pursued at one time.
Right. I got a question for Jerry. Jerry, recent trip to India. What did you learn there that you can bring back and apply to either portfolio companies at private equity or middle market companies?
Just the power of a broader perspective. It's just great to get out of our own heads and experience a different way of thinking. Like the guy who runs it currently is a guy named McKeel, who's run a company for 30 some odd years. We do a tremendous amount of work for a company called Google, and
I've heard of them.
If you don't, you can Google it.
Yeah.
But they pulled us overseas to help us support in other ways. We actually did an acquisition over there. And it's been really helpful for the way we look at things. I'll give one simple example. Akil, we were talking about different perspectives around what someone might have heard on a deal and some things that were misunderstood. He said, often every single belief is based in some level of fact, and then it's wrapped in some bias. And he said, we definitely want to get to the fact. That's what everybody knows. But really, the real value in a relationship is understanding the source of the bias. Those aren't conversations I'm typically having in Nashville, Tennessee. So it's such a great perspective. And then from a client perspective, it's really a great experience to understand how powerful we can be in a really collaborative way. The fact that we can be the face of their relationship here locally, a powerful team in India that's able to do much more at a more cost-effective basis in a fully engaged way. And we're able to do things faster and more effectively. The other thing I think is really interesting is historically India was looked at as a low-cost resource. Now it's such a great thought leadership option. So we're evaluating ways we can serve clients in innovation and way that we can take what they're trying to accomplish and see how we can use the world to do it more effectively.
Let's say on that, Craig mentioned that up to 20% of his time was spent on recruiting. How do you help either PE portfolio companies or companies going into PE? How do you save them time, energy, and money by bringing the right people to their organization?
We look at a transaction. We double down on the relationship. So a transaction will occur over the course of a relationship. We want to be at a point with our private equity clients that they've got some type of merger that they want to do. They're looking at a company in a city. They want to know more about it, and we might have a location there that's got a history. So yes, there will be transactions where they're looking for a new CEO or a new CFO.
Can you give us a specific instance of a company you worked with that they said, hey, here's what we're doing, we need your help?
Sure. We've got almost every single private equity firm will have some cycling in their controller level, some cycling in their CFO level. So we've got, we actually did it with our own firm in Quad C. We would do a broad-based analysis of their portfolio companies, and we would 9-block the strengths of each of their succession plans as well as their existing players, and then we would develop a three-year succession strategy, and we would prioritize where they needed the help most critically and where they had the luxury of being more patient. And that's something that really goes back to that relationship perspective of saying, let's play the long game. Where do you have the needs currently? And then let's see what it looks like in year 2, year 3, year 4.
Okay, great. Brian, a good question at pre-due diligence on M&A. Can you tell a story about a deal that didn't make it because of the due diligence?
Yeah, and when you talk about pre-deal, we heard a lot this morning about telling a story, and accounting firms you usually don't think about as storytellers, and I'm not claiming to be a good storyteller, but one thing I'm trying to do when
you can hire Craig.
Yeah, there's plenty of people here. I'm looking at Ryan too, but when we do what we call quality of earnings as part of our financial diligence, at the end of the day, we're going to step back from that schedule of EBITDA, right? Here's EBITDA for the last 2-3 years plus the last 12 months, and it's going up or down or it's flat. I always want to be able to step back and say, do I know why that's happening? And there may be a story that the investment bankers have told, there may be a story that the private equity firm has told that said, hey, it's, the growth is being driven here. We've got top line growth because we're expanding relationships within existing customers, and because we don't have to go out and prospect anymore, we can cut operating and selling expense, and that's why EBITDA is growing even faster. Okay, so we come in and try to validate that through digging in a layer below those numbers. I'm working on a project right now where we're actually advising the company that's going to launch a sale process. And so we're working hand in hand with the investment bankers, and something that I had never seen, and I've been doing this for 20 years, but the investment banker gave me their information memorandum, draft version, basically week 1 of me starting the project. And they said, here, we've written the SIM. You can probably use some of this stuff as you plan your diligence procedures. And sure enough, they'd written the whole story. Every place there was a number, there was, square brackets, red font, and a footnote that says GT is going to provide the actual numbers. But so, and so what happens when we fill in those numbers and the story's different, right? When you actually put in the numbers, the story's different from what everybody had been putting out in the market. That's when deals fall apart. And so either we come in in this case, we're working for the company. We're helping them get the story aligned with the investment bankers, which I think is really best practice, and we're seeing that more and more in the market. So when I come in on the buy side, very often the first thing I get is another accounting firm's sell side quality of earnings. And I can look at that and use that as a launch pad to hopefully work through the process. But in that case, I know the company has done a lot of work. The bankers, their private equity sponsors have, thoughtfully looked at the quality of earnings, looked for, adjustments and probably raised the profile of those so that they're more visible. But the deals that fall apart are the ones where when you dig into that next layer of financial information, the story doesn't line up, right? And it may be that if you had understood those trends beforehand, you could craft a story that was still a growth story, and the same deal would have happened. But whenever there's a disconnect, people get very nervous, very skeptical, and it doesn't take a lot at that point for a deal to die.
Yeah, nice story. Wish it was the truth.
Right.
Did they happen to you on the sell side? Because you do buy side and sell side, right?
Yes.
Has it ever happened to you on the sell side?
So what'll happen more often on the sell side will be, so we'll prepare that sell side quality of earnings report. There'll be a process launched, I've actually just finished one where we did a sell side a year ago. Process was launched. The shareholders, and this was a private equity owned company, declined to take any of the offers that were put on the table. And so a year goes by, and now there's an opportunity with another year of data, another year of performance to relaunch. And in fact, in this case, they decided to do a recapitalization. So they're going to keep the equity, refinance the debt, and they went back and leveraged that sell side quality of earnings to go out to the lending groups.
Ryan, can you speak to one of your stories? I'm thinking about Byron Brown. I want to talk about the story and why that's important, and what happened to him from start to finish.
So my comment about personal injury attorneys is going to catch up to me.
Yes.
Let me start with story. So what is story? Everybody's talking about that. It's a fun little buzzword that everybody talks about. But a story is something that we all know and we're familiar with. Good stories have good characters, right? They have a beginning, they have a middle, they have an end, and there's typically that hero's journey. So with us, we spend a lot of time with companies and individuals, and I'll get to that example. But individuals, in taking them and talking to them separately to find out what is the story, what is the arc that is consistent, and what are the themes and what are the values. And as those bubble up, what we can start to identify is if a company actually has a mission, vision, and values, does that align to their brand purpose, and does that brand have positioning? Okay, because you're all after customers at the end of the day, and customers have desires and needs. So the customer's desires and needs need to align to the brand's positioning and purpose, and that's a sweet spot. And that sweet spot is the gift. That's the gift in the hero's journey that is bestowed by the brand, the company, to the customer. So we have to get that right, and we do that with a lot of folks. And an example here locally was a fun one. I had a buddy who reached out to us, and he was working with a bunch of different groups here in Arizona, mostly media, radio, television, and he's a very colorful gentleman, Byron. Byron has a bald head. He's about 5'7", on a good day, maybe 5'8", covered in tattoos, went to ASU Law School. Doesn't have a single friend who's a lawyer. He doesn't like lawyers, and he doesn't like talking to lawyers. Sorry, Steve. And so the whole idea with him was very authentic to the fact that he found opportunity in personal injury, and he found opportunity in the customers that he was serving because he was over-serving them from other folks. And so his whole brand that we had crafted was authentic to him, and it was the anti-lawyer lawyer. So his commercial was, how do you know I'm the right attorney for you? Is it because I have this fancy suit? And he stands up and puts his arms out, and the sleeves get ripped off, and it's like, no, it's because I'll pick up the phone and I'll call you, right? And as he's doing that, the whole facade of marble columns and eagles and pillars and law books, it just gets eviscerated in front of him, breaking down that stereotype. And we launched that campaign for him 2 years ago. blew up his business right before Thanksgiving, actually ran it in English on Hispanic television here in Arizona, and we had to shut it off in a week because it was overperforming for him, and his paralegal couldn't keep up with the work. And now he's hired on. He's grown in the East Valley, and that's just one individual. We've done that for other companies here in Arizona too, who have been around for 25 years in the middle market doing brute force hand-to-hand combat at trade shows and associations, and have grown their business very well. But haven't had those themes resonate, and then haven't gone back and leveraged, sophisticated marketing that you can have today with CRM systems, and be able to go back to those customers and find out what are their desires, what are their needs, and then upsell and cross-sell to them.
Steve, you're a patent attorney, right?
No.
Or were a patent attorney?
No, never.
No patent attorneys?
No patent attorney.
Yeah. So we talked a little bit last night about, and we talked with Craig about the power of the trademark versus the power of the patent. Can you talk about, from a legal perspective, what do you see the trademark of value? I mean, do you see the trademark more valuable than the patent? I know Craig has his opinion. I'd like to hear from.
No, I agree with Craig. I mean, my wife's a licensed patent attorney, so I've kind of seen it from a.
Oh, you live with them.
I live. Yeah. She doesn't practice patent law, but I still think that in the world of the private equity investment bankers, that they need a deliverable, and they can check the box and they have a patent, and it makes them feel better, because just saying you're getting an intangible right doesn't really carry the water as well as there's an asset, because we're all used to having assets that we can value. But I've had a client that had Lloyd's of London that valued their patent portfolio at $120 million, and they went insolvent. And so you can't rely on your strong patent portfolio to get you near as far as your brand name and your business. And just from my experience as an attorney, I'd love to say that the patents are where it's at, as Craig did with his experience, but in seeing it from my experience, that they're not as important as people believe or think.
I totally agree too. It's the mom or the grandma test. Right, you guys familiar with this, right? If I ask you who's LeBron James, right, you're going to shake your head. I know who he is. If you ask your mom or your grandmother who LeBron James is, she's probably going to say sure. If you ask her who Joshua Jackson is, maybe she knows, right? So that comes down to the trademark, to the brand, to the reputational value. The challenge is that's not always on a financial statement, right? It's not always communicated, but it's out there. And so you have to create it, and you have to invest in it, and you have to defend it.
Yeah. Donna, I want to talk a little bit about how a company or a PE firm with a portfolio of clients, how they can lower their cost and risk by moving their W-2 employees over to your organization. And can you speak to the platform that you bring to the HR division or the HR department? Can you speak to those two things in terms of both cost savings and, cost savings? Can you speak to that?
Well, really, it really speaks to what their area of expertise is, right? So I have a story here recently where we had a longtime client here in Phoenix, and they, had private equity come in, and it's always a great compliment when that private equity firm, this one happened to be in Chicago, calls us and says, hey, one of our partners is starting this new firm, and the last firm he just, started and built, sold it for $4 billion, and we took over this company that was with you, and everything's so buttoned up in the life cycle of the employee, from the job description when they first come on to how they're treated there and the discretionary effort we get out of them. We'd love for you to, talk to this person about, starting this new firm. I mean, that's a great compliment, right? So, okay, we got that thing buttoned up. As far as the cost goes, there's the hard dollar cost and what you have to pay to get certain things for your employees. Right? So in a Netflix situation, there's 6 or 7 people. They're going out and they're trying to convince other talented people to come grow this huge idea, right? Where we're used to getting blockbuster videos, and they're going to say, hey, we're going to do this through the mail. Those people probably have other options, because that could be a risky value proposition for them to go work for this company that's a startup. Our value proposition is that we can put that company, and Netflix in this case, on par with any other Fortune 100 firm when that time comes to talk to them, not just about the salary, but hey, what are the benefits like, and what's it like to be an employee of this company, right? So we can kind of bring them from 0 to 60 immediately. As far as the cost goes, they take a look at what the cost is to ascertain these things. Could they do it better on their own? And then what risk are they avoiding in partnering with us if something does go wrong? Right, so if I'm buying one thing for $4 and something else for $6, and this is $2 less, but it gets me $50,000 in the hole because I don't have everything buttoned up, I would argue that ours is less expensive. Right? So maybe on the surface it is not, but you have to take a look at a little bit longer perspective, and then have something that's sustainable that you can go back and say, hey, what's the history been on that? Right, and as a public company, we can show that, and then how do we manage the risk on that piece as well?
Okay, got it. I have one more question, and then we can take questions from the audience. It's for Jerry. You probably have the most private equity experience and venture experience here. Can you tell us about your experience of negotiating valuation with some really value-added investors?
Well, we can talk a little bit last
Yeah.
time. It'd be interesting to get everybody's thoughts on what it's like having an angel investor versus a private equity investor. The very first time I was raising money, I was 31 years old, and I saw Lucius Birch, who was referred to me by a client. He'd taken 19 companies public to the New York Stock Exchange, and he smoked a pipe in his office, because that's what you can do when you take 19 companies public. And so I was leaving a big company. I'd always been a big company guy. We'd written a business plan, and we were 100% certain we were going to be successful, so we were willing to offer him 17.5% of the company for his investment in our business. And Crom Carmichael was in there also, our other investor. Lucius fired up his pipe and said, let me see if I understand the economics of this deal. Crom, they've offered us 17.5% of the company. We're putting in virtually all the money. Scratch that. All the money. They don't have $1 in revenue. They're telling us about a company. They're putting this stack of papers here, and we're taking all the risk, and they benevolently offered us 17.5% of the company. Crom, is there something wrong with my math? Let me tell you this usually operates, son. I get 80% of the company, and if you play lights out, there's an outside chance you can earn up to 49%. There's a delta between what you want and what I'm willing to provide. I said, Crom, Lucius, this is the first time I've ever raised money. It's like when I bought my wife's diamond. The jeweler said I was getting a good deal. I didn't know, though. He goes, it ain't gonna be all complicated. I ain't gonna ask you to put your wife's diamond up as collateral. It needs to be a darn sight fairer than 17.5% of your company. So ultimately, we settled somewhere north of 17.5% of the company for him. And he also gave me my single best advice on the way out. I said, Lucius, what advice do you have for me? You've invested in so many companies. He said, son, protect your nut. Because you sure don't want to come back and ask me for more money. It matters where we get our money.
Yeah, thank you. So I'd like to open it up to questions from the audience. We have the panel here. We have about 40 minutes to do questions, half an hour, 40 minutes to do questions. So one of the things I've noticed is that sometimes in these middle market companies, there's been an entrepreneur. He doesn't really have an exit strategy. He's been the guy who ran the company from startup to where they are now. There's two different skill sets in the sort of that group. There's the startup skill set, which exists. But how do you take the company from that, from where they are now? How do you find the right people to marry up with that company to take it to the next level, to $1 billion valuation? How do you do that?
Well, we're a pretty good case study of that because we were penny wise and pound foolish. As founders, we wanted to hang on to every single nickel, and we underhired in basically every position that would have supported our growth faster. Guess what happened in a transaction?
Devalue.
All of that is a deduct from the purchase price because we were under supported at the executive level. So we worked so much harder than we had to, and then ultimately we got less money in a transaction because they knew they had to invest in that. Mm-hmm. Then I think about that was one of the things about private equity. A lot of people say private equity is dangerous and all your 5 questions. The truth of it is, our experience, private equity is like adding a chess team. before we would look at acquisitions, we would bang rocks together almost and try to find out if it's the right decision. And now with private equity, we put it in the mathometer, and they're able to show us that, and all we have to decide is if it's a good cultural fit. So I think the timing of adding private equity really matters. They really influenced us in making a bigger hire on our chief people officer position, since we're in the people business. They influenced us in getting a stronger CIO. We under hired in that spot for so long that we had to hire somebody from our single largest competitor to get current in the technology piece. So we were a bit like the mechanic with the worst car on the road. So I personally can say there is no currency in waiting too long to add an amazing team.
Thank you.
Yeah, I want to say that in my experience, the player that's often most missing is the CFO, is a financial player, and because it's a cost, and I have so many clients, and they say we want to hire another engineer, or we're going to hire another salesperson because they're going to make money, but we don't want the CFO, and not having the right financial team together is what ultimately, from a legal perspective, costs them way more money on the legal side, because if they have the financials together, more often than not, the legal comes together much more efficiently and quickly. And so I can't stress enough for those of you that are thinking about your next hire, always making sure the financial team is in place, because that's critical long-term for the legal side as well.
Yeah.
So
Brian.
we see the value of that all the time when we're digging into the numbers. And I would echo the comment that the value, right, you're giving up the CEO salary, but the value that he's adding when you apply a multiple to the value he's creating, usually is a pretty easy ROI on that investment. But Craig sat up here and said, I've done three companies and never had a strong CFO, did it all myself. So we see it all the time, and it's it's not because you don't have a smart guy running the company. There's always a reason. From our perspective, there's never a good reason. We have clients on the private equity side. After we finish the diligence and we present the numbers, they always ask us, hey, we're not expecting you to write this down and put it in your report, but how's the finance team, right? CFO kind of on down. You guys do this all the time. You speak to CFOs and controllers all the time. What's your perspective? Do we need to replace somebody? Do we need to put something in the budget? And so that's happening in diligence, whether you know it or not. Behind the scenes, you're being evaluated when you're going through that process.
Would you guys all agree that CFO is being evaluated for?
For sure.
So, I mean, I think Jill is sort of the new type of CFO. She sales, marketing, she gets the whole thing, right?
Yeah, she gets it. And her comment about, she needed numbers, right? She needed to be able to tell the story, and it's not the numbers on the financial statement. It's, for her business, it's the metrics from the call center. And she didn't have the capital to go do that, but she figured out a way to get those numbers.
Yep.
And we, when we're going into founder-owned businesses and there's no financial team and we're doing our diligence sitting across from the CEO who's bootstrapped this thing and run it for 20 years, and we come in a couple of weeks, and because we have experience looking at businesses the way private equity firms do, we help him kind of gather that data and then put it out there for him and say, okay, well, here's the way that we're looking at it, and can you answer questions that we're seeing in the trends based on the way that we're analyzing it. And I can't tell you the number of CEOs I've had who said, wow, that's a really interesting way to look at my business. I wish I'd thought of that. And can you give me your spreadsheet when you're through with this? And it's something, that a couple of, dumb CPAs put together in a couple of weeks. He has been very successful running his business. He's created jobs. He's, provided a good income for himself, but doesn't have the experience, right, to go back and say, how does a private equity firm look at this? And then the private equity firm is going to take his company and say, okay, this is how we look at it, but we also know, by the way, how the big strategic buyers are going to look at it, and we'll help you put that story together.
Because you have to prepare for a couple exits.
Yep.
Right? You have to think beyond the private equity. You have to think, who are they selling to? Right?
And that's the chess team that you have, where they can think of the next
Exactly.
3 moves.
Yep. Question.
How small is too small to go after private equity?
Why don't you guys answer that? We're going to have private equity up here, and you can ask them directly. But why don't you guys answer some of that? Steve?
I had a client that got private equity about 3 years ago. They did $1.2 million and got $35 million in private equity. So you never know because there's fits or niches in places that the public company needed to fill, and they filled that role.
That question, why? Why did they get 35 million?
They got 35 million because there was a large public company that had a use of proceeds, and they had 150, 200 million they had to spend, and this was one of the places they could spend it and justify it to their shareholders.
Spend it or lose it.
Spend it or lose it.
Brian, want to answer that?
Yeah, I was just going to say we do a lot with private equity firms that are focused on technology and growth, and so work on some smaller transactions, and some of them have very large multiples. But if you look at the investment criteria, right, if you're comparing firms and doing your own research, and they say we're looking for companies with 10 million in EBITDA and top lines of $100 million, you have to remember too, you have to look at their portfolio companies, because a lot of the work I do is those add-ons to those portfolio companies. And so just because a firm, if you're learning that ecosystem and you're learning who's investing in companies that do what I do, I think it's important to look at that portfolio company, because they may be looking for an add-on, and that could be an avenue where, if you just stop at the investment criteria page on the website, you might rule them out.
We've done a few. Quickly, we did a dividend recap originally, to your point earlier. The hard thing about a private company is there's no monetizable currency. So a dividend recap gave a lot of our LLC owners a chance to monetize something, but it really added no mathometer. When we took private equity money, we were 160 million was the valuation, and through it allowed us to be so much more aggressive with acquisitions. It made us to make braver decisions, because our investors they'd already had a great return, so they weren't willing to go as hard. So we were able to, in 3 years, triple their money. And we went out recently with a $420 million valuation. That was about 18 months ago. So I think that, one, not looking at what we're giving up, but let's see what we're actually gaining. I thought that was great what the speaker said around the right private equity partners, and then just making sure that the organization is ready for it. When we took private equity money, not one single leader wanted private equity outside of me, really, because there was a risk that we'd go corporate and the world would change. And we invited our private equity team. We did frequently asked questions. We brought the entire team to Las Vegas, brought the private equity group out, and they asked a lot of questions of those private equity sponsors. By the time we had patiently done that, 100% of those players saw the reason for private equity. After that, people that didn't have equity, everybody else at VACO, negative 157% wanted private equity at that time. And we call that a beautiful fear, that with more money, more opportunity, and more security, that we'll be less than we would be without that. And so we really embraced that. And at our almost annual sales conference, we had our private equity guys do a video. And the video said, we like to open with Quad C. And the Quad C guys were in a suit and tie, and they said, we know it's tempting at a sales event to be excited, but let's remember why we're here, to increase shareholder value and increase our sales. You'll notice there are 2 drink tickets under each of your chairs. Use them sparingly. We like to point to our core beliefs. It's easier to walk up a foothill than climb a mountain. Through sameness, we will achieve adequate results. And then everybody's just watching this, and all of a sudden he goes, boop, 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 boop. One more thing, VACO. We're just bleeping with ya! And then we had a band go off, and everybody went crazy, and we said, who feels corporate now? So we really had to make everybody sick and then make them well. And with this last transaction, when we went with Olympus Partners, which has put $14 billion to work, guess what percentage people were objecting to it then? 0. 100% were there, because we nurtured that beautiful fear and made sure that we were all working together to make bigger better.
Thank you. Question in the front.
Either or is?
Who wants to take that on? Jerry, you want to take it? So can you do angel, family office, PE?
I think a family office could be the same as a PE in terms of size, and maybe you could speak to that one.
Only in patient money. So they don't
Right.
have to make a.
Exactly. My quick experience, and then I'd love to hear what you say about it, Steve. We had the best angel investors imaginable. Lucius was, I miss his money, I miss his wisdom, but most of all, I miss his quotability. He really was so instrumental, and he was curious about what we were doing. He was there when we took the call, and through 2009, when the world fell apart, Lucius was there, and we had two other people as well that were great until 2009. And then we're sitting in this room, and we never had issues. We thought we could always sell more, and I don't know if you remember, but that was a tough year. So two of our investors are pointing out everything we'd ever done wrong. Guess what Lucius was doing? He was reading the paper. And Toby says, "Lucius, you getting this?" He goes, "Well, it ain't that complicated." He goes, "Well, what do you think?" He goes, "Well, you may think it was easy for these boys, but we went through lawsuits early on. We went through companies that didn't work out. We had times when we didn't know how we were going to make it. We invested in these boys for a reason. I said we let them play out of it." Having that guy in that room completely changed the conversation. And I've been in other rooms where angel investors make the worst out of the best situation imaginable because they're not used to being in that scenario. So I would really, really spend a lot of time looking at my angel investors to how often have they invested before? What are their expectations in communication? Do they listen when you talk, or do they wait for their opportunity to talk? And then from a PE perspective, it really comes down to a consultative business partner, which is what we've had both times, and a company building factory. And I'm not opposed to a company building factory, but when we go to that level, we want to be inviting them in, and then instead of them sending their teams in. You want to talk about a family office?
Yes, Steve, can you speak to the type of angel investment here specifically, and then family office and PE here?
Yeah, I think angel investors are all over the map. I mean, there's organized groups that there's one in Tucson and Phoenix and Flagstaff historically that's an angel network, but anybody that writes a check, it could be an elderly woman in Sun City. God forbid it can be a group of doctors. It can be anyone that has it's a high net worth individual that's an accredited investor could be qualified as an angel, and they're all over the map. And some are not angels, and others are.
And then you have family offices. Ryan, you want to speak to a family office?
Yeah, we've got a great community here of family offices, and I would say they're very similar to PE, just on a smaller side, right? They're managing their own wealth, maybe 50 to 100 million under management. I would say most of those have a very clear direction of what they've done in the past and where they want to be, and then that's also kind of that barbell mentality of it's leveraged with real estate. There's some holdings in there that are very, very safe and value that's returning back to them. But they're going to bet on companies and people more than anything that they know and they believe in, more than the products or the services that are going to market. And they're going to be patient as well.
So checks are usually a lot smaller in the angel world. PE is a lot bigger. Usually it's they're beyond startup, and then there's an exit strategy with the PE. Any other questions? No other questions for the panel? Great, guys. Thank you very much. Appreciate it.
Yeah, man.
So